Good afternoon, everyone. It gives me great pleasure to welcome you all to yet another interesting session of the Brain Gain Expertise series organized by the Accounting Standards Board of the ICI. We truly value your participation as we turn our focus today to a subject of growing importance in financial reporting, common issues in accounting for share based payments, lessons from practice. This 16th webinar in the series reflects our ongoing endeavor to strengthen professional knowledge and foster clarity on complex accounting topics. In today's webinar, we will delve in the practical challenges and common pitfalls encouraged in accounting for share-based payments under Ind AS 102. The discussion will cover key areas such as classification of awards, equity settled versus cash settled, grant date determination, fair value measurement, vesting conditions, and expense recognition. We will also address disclosure requirements and explore illustrative examples and implementation experiences that shed light on the interpretation and application of the standard in real world scenarios. Through the interactive session, we aim to provide clarity on how professionals can navigate these complexities to encourage transparency, consistency, and compliance in financial statements. Starting with today's webinar, we are excited to make our session more interactive by incorporating live polls questions. We encourage all participants to take part by clicking on the open poll button whenever a question is posed by the speaker. Your responses will help shape the conversation and make the session more engaging for everyone. We look forward to rich and encouraging discussion. Thank you once again for joining us. We are privileged to extend a very warm welcome to our esteemed speaker for today's session, CA Karthikeya Kandoiji. Before we move into the technical discussion, it's my pleasure to introduce the moderator for today's webinar, CA Neha Arora. CA Neha Arora is qualified chartered accountant with over 13 years of post-qualification experience and a commerce graduate from Delhi University. CA Neha Arora has been into the industry having diversified experience of handling various compliances right from accounting, auditing, financial reporting, taxation to company law matters, etc. CA Neha Arora has done various certificate courses, namely certificate course in service tax from ICI, diploma in IFRS from ACCA UK, certificate course on Ind AS, and certificate course in artificial intelligence level 1 from ICI. With this, I would now request Neha Arora ma'am to address the webinar and give a brief introduction of our eminent speaker, CA Karthikeya Kandoiji sir. Over to you, ma'am.
Thank you, CA Rahulji, for this warm introduction. And I once again thanks my sincere thanks to ASB of ICI for giving me another opportunity. Good afternoon, everyone, and a very warm welcome to today's Brain Gain session organized by ASB of ICI. Our discussion centers on a topic that continues to challenge both preparers and auditors alike, share-based payment transactions. Purpose behind conceptualizing share-based payments transactions is to align the interest of employees with those of the company. Companies aim to retain their employees for a longer period, thereby avoiding the recurring cost of recruitment, training, and settlement that arise when employees frequently leave. To achieve this, companies often offer employees a vision that if they continue to work with the organization for a defined period, say 3 years, they will be rewarded with the company's shares. These shares may either be granted free of cost or at a nominal price compared to the market price. This mechanism instills a sense of ownership and motivation among employees, inspiring them to contribute more diligently and sincerely towards the company's growth and success. With the increasing use of equity and stock options as part of employee remuneration, Ind AS 102 or IFRS 2 has become pivotal in ensuring transparent recognition and fair measurement of these transactions. However, in practice, we continue to encounter complex issues, from determining fair value of options, handling modifications or cancellations, to accounting for group share-based payments and deferred tax implications. Today's session will help us unpack these complexities, bridging the gap between principle and practice. I would encourage everyone to bring forth practical insights and questions that can enrich our collective understanding. To help understand the various nuances of the standard, we have with us today CA Karthikeya Kandoiji. So Kartikeya Kandoi ji is a fellow actuary, a gold medalist actuary in India, UK, and Sri Lanka. He is a fellow chartered accountant and a member of the Institute of Actuaries of India. He is a special invitee on the Accounting Standard Board of ICAI for the council year 23 to 25. He is a member of the Insurance Accounting Committee of International Actuarial Association. He is a member of the ICAI and IAI study group of EDM on Ind AS 117 insurance contracts. He has been a faculty for certificate course on Ind AS, deep dive course on share-based payments organized by ASB of ICAI. He is the founder and proprietor in a firm and offers consultancy services of actuary and CA. He has a decade of experience in the actuarial field, including 8 years of post-qualification experience with a specialization in employee benefits. He's an all India topper in the subjects special technical employee benefits and pensions and core application modeling and documentation at the actuary exam and has secured 15th all India rank 99% in the accountancy paper at the CA/IPCC level. He is one of the youngest professionals in India to qualify as an actuary at the age of 24 after having qualified as a CA at the age of 21. He is the youngest actuary to serve as council member of the Institute of Actuaries of India. His expertise lies in providing 360-degree solutions for actuarial, accounting, and advisory globally in insurance and across industries for employee benefits, including ESOPs. He has consulted 100 plus companies for ESOP advisory and 700 plus companies for employee benefit actuarial valuation. He provides support to auditing firms on actuarial valuation review and training as well. With this, I request CA Kartikeya Kandoi ji to start the session and walk us through the standard. CA Kartikeya Kandoi, sir.
Thank you.
Over to you, please.
Thank you very much, Neha ji, for introduction and setting the context for the today's program. I also like to thank Institute for bringing up this Brain Gain series, for helping our professionals on the relevant topics and giving me an opportunity to discuss on the relevant topic of employee stock option plans, which is very much common and interesting in the today's time. Let me share my screen. I hope the screen is visible. So just a small disclaimer, the views presented are my own views and not represent the views of the Actuaries Institute or the CA Institute. So as per the context set by Neha ji, we will be discussing on the ESOPs, their Ind AS 102, what is the requirements, what are the vesting conditions, how they need to be accounted, then special accounting treatment for the modification, cancellations, forfeitures. We'll also discuss about the group share-based payment arrangements, some key differences between the ICAI guidance note versus Ind AS 102, taxation and disclosure requirements, and obviously questions to make it more interactive. We have certain poll questions as well, so you can use the poll button whenever we ask you for the poll questions. Also, I would encourage all the participants to post the questions in the Q&A so that we will take towards the end of the session. Coming to the employee stock option plan, mainly ESOP is giving a kind of ownership, benefit and ownership kind of trust to the employees in the company. That's why companies come up with the ESOP, because now this giving a ESOP in the salary structure or as a long-term incentive will make employees also part of the ownership. So employees' goal will be aligned with the goal of the company, because we all know that as a company, the management, the goal is to maximize the shareholders' wealth. So when the share price goes, the employees' wealth will also increase as part of their ESOP holder. So basically this ESOP serves as a purpose to align the employee's goal with the company's goal, and this will award the employees for their long-term contribution. Mainly ESOPs are given because employees have done a good amount of service in the company. So to award that prior years of service, companies giving them the ESOPs, plus there are certain vesting conditions. For example, employee have to serve the company for next 2 years, 3 years. There can be certain performance conditions which we will discuss in detail. So these kind of conditions will ensure that there is enough long-term commitment from the employees and also enough long-term performance by the employees, so that will encourage more efficient service from the employees in exchange of the employee benefits. If we talk about the different classifications of the employee benefits under Ind AS 102 or our guidance note of ICAI, there are mainly the classification lies into the equity settled and the cash settled, but then which predominantly broken down into 4 parts over here. The first one is employee stock option plans, which is popularly known as ESOP. This is company is giving the benefit to the employees in the form of the equity shares. So, for example, company have granted 1,000 ESOPs to the employee, which will vest over, let's say, 2 years time period. So the outflow from the company is the equity share. Company is not giving out the cash, it is giving the outflow in the form of the equity shares. These ESOPs can be given to our own employees, they can be given to the subsidiary employees also. The second one is the share appreciation right. So this is more like a cash settled plan where cash incentive is given to the employees, which is linked to the share price of the company. So for example, on the grant date, share price of company is, let's say, 100 rupees, and company is giving a benefit to the employee that whatever increase in the share price over the vesting period over and above that base 100 rupees price, that increase, or you can say appreciation in the share price, we will give you as a cash settlement. So this is called as a share appreciation right. We can call it as a cash settled options as well. The third one over here, this is a combination of the first two, which is also called as a share-based payment with a cash alternative. Within this scheme of share-based payment with cash alternative, there can be this alternative. So basically, ESOP itself is an option. Now there is another option attached because we have a cash alternative. So this option can be given either to the employee, that employee can choose at the time of final settlement that whether they want the final settlement in cash or they want the equity. So this choice of settlement can be there with the employee, or this choice of settlement can be there with the employer also. For example, company have given a ESOP benefit to the employees, but there is a condition that company have a option that at the time of settlement of the final benefit, company can give either equity shares as a discharge of obligation, or company can give equity shares, or they can give cash. Cash which is relevant to the increase in the exercise price. For example, at the time of settlement, the market value of share is, let's say, 1,000 rupees and exercise price is 400 rupees, which is given to the employee. So 600 is the net settlement which company will do. So this is a kind of a share-based payment cash alternative plan where company do not have a explicit obligation of cash because they have given a option of equity and cash both. The fourth one over here, this is employee stock purchase scheme. In this kind of scheme, shares are sold to the employees. You can say shares are allotted to the employees on the day one only, but these shares will be subject to lock-in period. For example, current share market price is, let's say, 200 rupees, and company have offered these shares to the employees at 120 rupees. This 80 rupees discount is given from the current market value of the shares. Now, ideally, as per Companies Act, we cannot give the shares at a price lower than the fair value of the shares. So why it is allowed? The reason is there is a minimum lock-in period required for these shares. So this is under the SEBI regulation only that company can give employee stock purchase scheme with a minimum lock-in period of 1 year. So I hope it is clear on the type of the employee benefits. Now, our major discussion will revolve around the equity settled plan with the differences between equity settled and cash settled, and then how eventually both will turn out for the accounting purpose. So coming on the ESOP, so basically ESOP is a right of the employee to purchase the share in the future at a predetermined price. So basically it is not an obligation of the employee. If employee wants to subscribe to the share, they can subscribe, or if they do not want to subscribe, they can let the option lapse. For example, let us say this is ESOP, you can term similar to the call option which is available in the market for any of the listed company share price or the Nifty call option, etc. Because in those call option also, the purchaser of the call have a right to subscribe to the share at a predetermined price. So in case of ESOPs, there are a lot of vesting conditions, because on the day one, we are only granting the options to the employee, which will be subject to certain vesting conditions. So employee have to vest these benefits by serving these vesting conditions. Once the vesting conditions are satisfied, now what can be vesting conditions? It can be service condition that employee have to serve, say, 3 years. Further, it can be graded vesting also. For example, total vesting period is 3 years, but you serve 1 year, you get, say, 30%. You complete another 1 year, you get another 30%. You complete third year, you get 40%. So this is called as a graded vesting. Or there can be single vesting or bullet vesting, where you have to serve full 3 years to complete 100% vesting. So both type of awards can be given by the company, either graded vesting or single vesting. So this is service-based condition. Another condition can be performance condition, where performance of the employee can be evaluated. For example, employees are given certain key responsibility areas, KRA, and based on that, every year company have a rating system of the employee, let's say 4 out of 5, 5 out of 5, etc. So company can attach a vesting condition that if the performance is 4 and above, they will get a benefit, otherwise they do not get benefit. Or they can put a condition that if rating is 3, then they will get, let's say, 60% of the awarded benefit. If rating is 4, they will get, say, 100% of the awarded benefit. If it is rating 2 or below, they will get no benefit. So these kind of performance metric condition can be applied to the benefit. So this was individual performance. Similarly, there can be performance of the company as well. For example, company can give a condition that revenue of the company should grow by 10% every year. We can have a condition like profitability should grow by 20% every year. So these type of conditions can be attached. Further, if company want to incentivize the employee, they can put a condition that if profit is increasing by, say, 20%, then your benefit will unlock. But if it is beyond 25%, then your benefit will further increase. So these kind of conditions can also be built into the scheme design. Now, other type of vesting condition is a market condition, where the vesting of benefit will depend on the achieving of certain share price of the company. For example, let's say currently share price of the company is 100 rupees. Then company put a condition that if your share price goes from 100 to 1000, or say 100 to 500, then only benefit will vest, otherwise it will not vest. So these kind of vesting conditions can be put. So once vesting condition is completed by the employee, then it is called as a vested ESOP. How the accounting treatment differs for all of these vesting conditions, we will discuss in detail in the next few slides. But this is an overall context of what are the vesting conditions and why these are very much relevant in framing of the ESOP scheme plus in the accounting. Now, once the benefit is vested, employee have a right to exercise the option by paying the exercise money. At this time of the exercise of shares, or you can say exercise of options, employee will also have to pay towards the tax, because ESOP involves the perquisite tax. So this perquisite tax needs to be paid at the time of exercise of the options. Okay, so now here we have some of the key regulatory aspects that we need to know. For example, ESOPs are granted as per the section 62(1)(b). Then we have the SEBI regulations, Rule 12 for the unlisted companies, which requires a special resolution by the shareholders. For accounting, we have IFRS 2 for IFRS companies, Ind AS 102 for Ind AS compliant companies, and Guidance Note 2020 version for accounting standard companies. In US GAAP, we have Accounting Standard Codification 718 for employees' share-based payments. If we see Ind AS 102 and IFRS 2, they are same. There are no differences. In Guidance Note versus Ind AS, again, we will discuss in detail. But there are no much differences in the accounting principles. One key difference is there in the Guidance Note versus Ind AS 102 is regarding the method of amortization of expense. For example, Guidance Note gives an option of intrinsic value versus fair value, but Ind AS have a requirement to follow the fair value method. Now coming to some of the practical aspects of the fair value measurement, like we just discussed that Ind AS requires fair value to be calculated for the ESOP expense accounting. So what are the practical aspects and various inputs which goes to this fair value measurement? Now, if we talk about this ESOP accounting expenditure, so this will typically require two key valuations. One is, if it is an unlisted company, we first need to have the company share price available, because once company share price is available, then only we can perform the ESOP valuation. So first valuation is for the company share price valuation if it is an unlisted company. If it is listed entity, then we have company share price from BSE, NSE. Then it requires fair value of the option, which can be done either by the Black-Scholes model, binomial model, or Monte Carlo simulation. All these models have their own advantage, disadvantage, and the cases when it will be better to use. So for example, Black-Scholes model is the most widely used model for the listed and unlisted companies. The reason is it is quite available in the industry. This is one of the model which we have learned in our CA curriculum as well. And this is having easy to calculation numbers. Now, since it is easy model, it will have some disadvantage also. For example, if company have a ESOP scheme which is having market condition, like there is a market condition that share price should go from 100 to 500, then only benefit will vest, otherwise it will not vest. So these kind of complexities can be modeled in the either binomial model or the Monte Carlo simulation model. But the plain Black-Scholes model will not be helpful in this kind of valuations. Now, coming to the date of measurement, this is also a very important aspect on which date we need to calculate all this fair value. So the accounting standard says that if it is an equity settled plan, then we have to calculate the fair value on the grant date. On the grant date only, we have to calculate the fair value. Then this fair value will be logged for the whole lifetime of that ESOP, and that same fair value we need to amortize. If share price goes up or goes down, we do not require to change this fair value of the option if it is an equity settled plan. But if it is a cash settled plan, company have an obligation to pay the cash as per the final ultimate share price of the company, because that share price will keep on changing and company's obligation will also keep on changing. But in equity settled, the obligation was fixed, that it is equity shares. So that's why in case of equity settled plan, the calculation was also fixed on the day one grant date only. But in cash settled plan, since obligation amount will keep on changing, this fair value will also keep on changing from grant date to every reporting date to the settlement date. So I hope it is clear that why the cash settled plan requires the fair value to be recalculated again and again for every balance sheet date, or you can say reporting date till the settlement time. One more important feature is in case of cash settled plan, overall accounting expenditure during the lifetime of ESOP will be total amount what company is going to pay. So whatever is our total outflow, actual outflow, that will be cumulative expenditure which we are making in case of cash settled plan. But in case of equity settled plan, company settling the equity, so there are various nuances of the which amount we need to debit to the P&L, or when we can reverse or we cannot reverse the expense. Now this is the formula for the Black-Scholes model, which I hope all of our friends are aware of, which is we have seen in our CA examination. Only one thing we have added, which is not as part of our CA curriculum, is this dividend yield. Because when we study the Black-Scholes formula, that is without dividend yield. But since shares also have a features of dividend, and these are the long-term options, not just 1-2 months options. These are pretty long-term options of 2 to 3, 4, 5 years long-term. So dividend yield will play a major role that we need to factor into the Black-Scholes model. So this formula is with incorporating the dividend yield. Here Q stands for the dividend yield per annum. So now we will talk about all of these parameters and their practical issues, you can say how they can be considered. So first important parameter is the share price on the grant date. So for listed companies, the share price can come from the stock exchange, but from unlisted company, we need to have the share price as per the independent valuation report as given in this guidance note, as well as the Ind AS 102. Now for listed companies also there can be some complexity sometime, although it is grant date fair value, but sometimes it is considered as a previous day closing price or current day closing price. So how that needs to be considered? Usually as a practice, what we see when this ESOP was granted. For example, let us say if it is granted in, let's say, you can say morning hours. So obviously company do not have the end of the day closing share price. So it is ideal to consider the previous day closing share price for such grant dates, because standard says we have to consider grant date fair value. But then some kind of professional judgment needs to be done on which grant date share price needs to be considered. Some professional judgment is required in the determination of grant date itself. For example, if company have given a joining letter to the employee In that joining letter, they have given the ESOP quantity of 1,000 quantity, let's say, but there is no ESOP scheme, because ESOP scheme requires approval of shareholders via special resolution. So the standard says that if such ESOP grant is relevant and subject to certain approval from the shareholders, then grant date should be considered when such approval is received. So although company have committed this grant in the joining letter without approval, so that cannot be considered as a granted. Grant date should be whenever such approval is taken. Similarly, let's say for listed company also, grant of ESOP requires NRC approval. So company cannot consider grant date of any random date whenever they have given in the joining letter or a open communication, etc. It has to be proper approved document. Based on that, grant date should be considered. Coming to the second important parameter, which is the exercise price of the option. Exercise price is usually given in the grant letter, that okay, employee can exercise the ESOP on, let's say, 10 rupees, 20 rupees, or whatever be the current share price, or some discount to that. One important thing, as an auditor, one can check this grant price is usually approved in the ESOP scheme also as part of the requirement of the SEBI regulation. So ideally one should check what is the pricing formula for the exercise price is given in the ESOP scheme, which is approved in the special resolution, because your ultimate grant price should be within that pricing formula, because the SEBI regulation allows the company to keep a exercise price up to the face value of the share, let's say 10 rupees, and there is as such no upper cap. So that needs to be checked by the auditor or the valuer that this ESOP grant price is well within the range approved. The next important parameter for fair value is the expected number of period to exercise the ESOP. So this is a time period from the grant date to the date of expected vesting. That when not expected vesting, expected date of exercise. Basically, till the time from the grant till expected exercise, how many years employee will take to exercise. For example, let us say we have given a ESOP with a 2 years vesting period, and after 2 years, employee have 5 years time to exercise the ESOP. So one can say employee can come to the company to exercise the shares from time 2 till time 7, because they have 5 years after the vesting. So either they can come at the time of 2 years, they can come at the time of 7 years. So standard requires we need to have a suitable assumption somewhere in between 2 to 7. It can be the 2, it can be 3, 4, 5, 6, 7. Any suitable assumption we need to consider. But the standard says we cannot blindly take the last period, which is 7 years, because we have to consider expected early exercise of ESOP as well, because employee can exercise at 3 years, 4 years, 2 years also. So in calculation of this expected length, again the professional judgment and the past experience plus exercise price range, type of employees to whom it is given, they are very much relevant. For example, let us say if exercise price is only 10 rupees, which is the face value of share, so it may be possible that employees may exercise it little early after the vesting date, because exercise price is low, although they have to pay taxation at the time of exercise of shares. So one very important point is one should check for the past experience. This expected term of the option will have a very important role in this formula of Black-Scholes model. The reason is higher this number, mostly higher will be your ESOP fair value. If the ESOP is not at a very in the money option like 2 rupees kind of fair value, why this expected term is very important? The standard says that first you determine this expected term, then based on this expected term, we have to consider the risk-free rate for that much term of the option. For example, if my expected term is 3 years, I have to take zero yield coupon rate of 3 years bond. If my expected term was 3 years, then I have to take dividend yield based on the historical data trend of last 3 years. If my expected period was 3 years, let's say in our example, so my volatility assumption also has to be based on that 3 years past data. So for volatility assumption, it is also one of the very important assumption. Standard says first we have to consider volatility of the same transaction available in the market, but that is not possible because ESOP is a very long-term product of the option, and options which we have in the market, they are having only 1-2 month kind of period in the option. So the last option what we have in accounting standard for volatility calculation is the share price volatility of the historical increase or decrease or volatility in the share price. So we have to consider the past trend of share price growth. What is the volatility in the share price? Now this term of the past needs to be consistent with this expected term. Further, it says that if there are any unusual period of high volatility, or you can say, for example, unusual period like COVID is there, then we have to exclude such exceptional period while calculating the historical volatility. All these things are given in the appendix B of the Ind AS 102, where they have discussed on all these parameters. Now, having said calculated the fair value of option, we need to amortize this fair value of option as per the straight line method over the vesting period. So whatever is our vesting period of options, during this vesting period, we have to amortize this fair value of the option. Now, since we have discussed something about these vesting conditions, so accounting standard says that for accounting purpose, any non-market conditions, for example, what is non-market condition? It can be performance of the individual employee, performance of the company, or service conditions. All these conditions needs to be factored in the number of options which are expected to ultimately vest. Because what happens when we have to do the ESOP expense calculation, we need to have two items. One is what is the fair value of option. Then second is what is number of options expected to vest. So this non-market condition has to be applied in the number of options expected to vest. For example, we have granted 100 options, so we have to use certain probability that let's say 85 ESOP will vest by achieving the performance and completion of service, etc. If there is a market condition or there is a non-vesting condition is something like which is not in the control of company and employees, and they will drive the vesting of option. So this condition needs to be factored in the fair value of the option itself on the measurement date and not in the number of options. So coming to some more accounting aspects, so that will clear what we just discussed. So here we have one simple example. Let us say a company have granted 10,000 ESOPs, which is equity settled in the nature, and these are given to only one member who is CEO of the company with a vesting period of 2 years. And grant date fair value of option is 20 rupees per share. Now, since given this benefit is given only to the one member, and company expect the member to continue the organization, so company expect that options expected to vest will also be 10,000 because it is only one employee and they feel that member will continue. So they book full 10,000 ESOP expense. So 10,000 multiplied by 20, my total expenditure is 2 lakh rupees during the total ESOP tenure. Since vesting period is 2 years, 1 lakh each every year will be accounted as the expense. And so this 1 lakh will be debited as expense and credited to the ESOP reserve. Now the question is where these both items will sit in the financials. So ESOP expense will sit in the employee benefit cost, or if the employee is working on some project which is resulting into generation of property, plant, equipment, if we are capitalizing the employee benefit cost of those kind of employees, then this ESOP expense will also needs to be capitalized, because all type of employee benefit cost for that category of member we need to capitalize. If employee service is also expensed out as a general employee benefit expense, then this ESOP cost will also be expensed out. This is about the debit transaction. Now on the credit side, we have ESOP reserve. So that ESOP reserve will stand as part of other equity in the balance sheet. This ESOP reserve will not form a part of provisions. This is other equity. Now let me ask one question. Let's say if this is not a equity settled, if this is a cash settled plan, then what will happen? So if it is cash settled plan, then how the life will change in the accounting, that we have to discuss on this screen only. So let's say in equity settled, we have considered the fair value of the grant date, which is 20 rupees. Now after 1 year, 2 year, let's say share price goes up. So this 20 will also go up technically. So in equity settled, this 20 was fixed. But in case of cash settled plan, we have to consider the fair value on the date of reporting date. So now let's say after 1 year, this 20 moves to 30 rupees. So in that scenario, if the 30 rupees is my fair value of option at the end of first year, which is my reporting date, then for cash settled plan, this 30 will be relevant and 20 will be irrelevant. So based on 30 rupees fair value on the reporting date for cash settled plan, my accounting expenditure will be 30 into 10,000 divided by 2 years. So you can say 1,50,000 will be my expense in the year 1 for cash settled plan. So I hope it is clear to everyone. For cash settled plan, the accounting will be driven by the fair value on the reporting date. Now in the year 2, again we have to see what is the fair value at the end of the year 2. It may be possible that share price can go up from 30 to 40. It can go down 30 to 10 also. Both scenarios possible. So in each of these scenarios, for cash settled plan, we have to do the true up or true down of the fair value of option. Let's say 30 goes to 40. So in that case, my lifetime cost will become 4 lakh rupees. In year 1, I have already booked 1,50,000. So year 2 expenditure will be 2,50,000. But taking another scenario, 30 rupees goes down to say 10 rupees only as a fair value of that option. So in that case, my cumulative cost for 2 years is now only 1 lakh into 10,000 shares. So 1 lakh rupees. But my PNL have already taken 1,50,000. So question is, can we reverse this 50,000 in year 2? So answer is yes. We have to reverse this 50,000 in the year 2 in cash settled plan, because we have to consider fair value on the reporting date. Now question is, in case of cash settled plan, where this debit credit impact will go. So debit will have a same treatment. If the employee salary is capitalized, then this ESOP cost will also be capitalized. If employee salary is expensed out as a regular employee benefit expense, then this cash settled option expense will also be expensed out as a employee benefit expense. And the credit side now will go to the provisions and not the other equity. So this is the difference. And one of the error found in the financial reporting of some of the companies. That company have disclosed the ESOP reserve in the provisions or cash settle plan in the other equity, vice versa kind of situation. So that has to be appropriately taken care by the company, that if it is an equity settle plan, ESOP reserve will form part of the other equity and not the provisions. Now, let us discuss para 19 and 20 of Ind AS 102, which extensively deals with these vesting conditions, because we are touching again and again on the vesting conditions. They are very much relevant from the ESOP scheme design perspective as well as the accounting. Now we will have a chart on the same. So first one is the service condition. So service condition was very clear. You have to serve 2 years, you get the benefit. If you don't serve, then you do not get the benefit. So the standard says this service condition and the non-market performance condition, these two has to be factored in the number of options which are expected to vest. Further, in the para 19 and 20, the standard says these options expected to vest, we have to keep on recalculating again and again on every balance sheet date or every reporting date. For example, there is a vesting period of say 4 years. So at the end of first year, when you are doing the accounting expenditure, that time you estimate that my active ESOP is, let's say, 1 lakh, but in the future 10,000 will go overall till the end of 4th year. So you consider 90,000 as a ESOP expected to vest. But when you reach to year 2, you find that now out of 1 lakh 8,000 already left. So I left with only 92,000 active ESOP. So then you have to re-estimate what is my current expected number of options that will vest. So for example, that will come to say 84,000, 80,000, etc. So that expected option now we need to consider for the calculation of ESOP expense. So this number of options expected to vest, this will keep on changing on every reporting date. In case of equity settle plan also. But what was fixed in equity settle plan, if you remember, it was the fair value of the option that was fixed on the measurement date. And market condition and non-vesting condition, they needs to be allowed in the fair value of option on the measurement date, which is the grant date. So there is one interesting paragraph also in the standard which says that, let us say some ESOP is granted based on the market condition. For example, current share price is 100. If share price touches 500, then only you will get the benefit. Otherwise, you do not get the benefit. So this is the market condition. This market condition you have factored into your fair value of option on the grant date. Okay. Then there is another service condition that you have to serve 2 years the company. Now 2 years have completed. Employees are very diligent. They have served full 2 years with the company. Now they are asking for the ESOP. But now the ESOP has not touched the market condition. So due to this failure of market condition, the question is whether ultimately employee will receive any benefit. No, employee will not receive the benefit because ESOP is not vested. The reason is failure of market condition. But question is whether employees have satisfied the service condition. Yes, employees have satisfied the service condition. So in this kind of scenario, the question is whether ultimately we have to book the ESOP expense or not. So for this kind of scenario, accounting standard says that although your market condition is not satisfied, but this market condition needs to be factored in only on the day one. Now you cannot change this fair value of the option, and since service condition is already met, you have to book the expense. So although employee is not getting anything, they are not getting final ESOP benefit, but still in the P&L, my expense is going as a ESOP expense. So this is the requirement of the Ind AS 102, as well as the same requirement is there in the guidance note of ICAI as well. So I hope it is clear to all of you on the treatment of the vesting conditions. You can always post your questions on Q&A. We will take them. Now let us have one poll question based on the discussion we have done so far. Let me explain the question, then our team will launch the poll question also, which you can answer. So first question is, which type of vesting condition will affect my measurement of the fair value on the grant date? Whether service condition will have a potential impact on non-market condition or market condition or all. What is the most appropriate answer in your view that will affect the grant date fair value? The second question is, at what value equity settled share-based payment needs to be initially recognized in case of Ind AS 102? Whether it needs to be recognized as per intrinsic value or fair value or par value or the face value. Let us have the poll question one by one on the screen and request the members to answer the poll question. Let us have the second poll question. Okay, just a request to the technical team to check from the background whether the members are able to see the session, because I received one question from on my WhatsApp from one of my friend that there is some error on the screen. So just to check from the background that from another device that whether the participants are able to see, or you can check whether the questions are coming, so at least we are aware that the two-way communication is in the process. Rahulji, can you check? Okay, perfect. So we are good to proceed. So let us see one numerical example to make the life more clear for the this market condition and all these parameters. So I have one example on the screen where company have granted the ESOP with the 50-50% or you can say 40-60% kind of vesting conditions, graded vesting, and say ESOP is granted on 1st October 25 with a vesting condition of 1 year and 2 years. So one important assumption in the model is to consider what is the expected term of the option. So let's say in this case, we assume 2 years as a estimated term of period, let's say, for both the tranches. And share price on the grant as is 500 rupees and exercise price is 450 rupees. So I think there is some typo error. This is actually 3 years and not 2 years. So there is some typo error over here. So based on this parameter and the risk-free rate of 5.90 and 6.02%, then dividend yield of 2%, and volatility of 40%. If let's say there is no market condition, if it is a plain vanilla ESOP transaction where current share price is 500 rupees, company have given the ESOP at a 10% discount to the market value, so exercise price is given 450 rupees. So in this kind of scenario, the fair value of option will come to 143 rupees and 168 rupees for each of the tranche. And the standard requires that each of these two tranches needs to be considered as a separate grant for the purpose of expense amortization. For example, let us say if company have granted total 1 lakh option with a vesting ratio of say 50-50%. So first 50,000 will be amortized based on this price over the vesting period, which is October 25 to October 26. So for in the 1 year, for 50,000 option, we have to amortize 143 rupees per ESOP. Now the important point here is this 50,000 is the granted option. So we have to calculate the options expected to vest. Let's say out of 50,000, company expect that 5,000 will leave. So 45,000 is expected to vest. So 45,000 ESOP into 143 will be amortized in the P&L. For the second tranche, again there is 50,000 options granted, but here they have to complete 2 years of service from October 25 to October 27. So they have to serve 2 years in the company. So attrition rate has to be considered for 2 years. Let's say company expect the number of options to expected to vest is say 40,000. So 40,000 will be amortized for this 168 rupees fair value of option over the 2 years time period. Now I have tweaked one condition in this plain transaction. So this is as per the Black-Scholes model. Now let's say a company put a condition that today share price is 500 rupees, but this benefit will vest to you on these respective dates if our share price is reaching to 1,000 rupees. If after 2 years or this whatever the vesting period, respective vesting period, my share price, if it is not 1,000, you will not get benefit. It has to be minimum 1,000 rupees. Then only you will get the benefit. So this is the market condition attached in the valuation. If this kind of market condition is there, so we have to incorporate this market condition in the day one in the fair value of option itself. Now simple Black-Scholes model will not work. We have to use Monte Carlo simulation. So based on that simulation model, let's say fair value of option is coming to 66 rupees for the tranche 1 and 107 rupees for the tranche 2. Now the standard says this fair value we need to amortize for the number of options which are expected to vest, which is 45,000 and 40,000 in our earlier discussion. So I hope it is clear that how the market condition and no market condition will change our P&L valuation methodology. Now it may be possible that after 2 years or after 1 year of the respective vesting condition, number of ESOP which is actually vesting by factoring the actual attrition and all, they can be either high or low than the original earlier estimate. So that we have to true up and true down. But whether market condition is meeting or not meeting, that will have no effect on the ultimate expense. Ultimate expense we have to book as per the 66 and 107, no adjustment to this price after the grant date. So I hope it is clear. This is well as per the Ind AS 102 and the guidance note ICAI. Now moving on to the another key important aspects. If this is clear, the next aspects will be much easy to understand. So let us say now we are discussing on the modification of equity settled plans. So point is, what is modification? Let us say company have granted the ESOP at a at the time when share price was say 500 rupees. So that time we have granted the ESOP with the exercise price of 450 as our like earlier example. But now after certain time period, company observed that our share price has reached to 200 rupees. And they feel that ESOP is no longer attractive to the employee. And they want to reprice the exercise price. So from 450, they reduced to 750 rupees exercise price. So this is called as modification of the ESOP. They can do the changes in the exercise price. They can do changes in the vesting period. Like earlier vesting period, let's say 2 years, which they reduced to 1.5 years or something like that. These are kind of the modifications they are doing. Or they can do the removal of market conditions. So there are a lot of modifications can be done. So the standard says under the para 27, which is very important, that entity shall, as a minimum, we have to recognize the services received, which is measured at the grant date fair value of the equity instrument granted, unless those equity instrument do not vest because of failure to satisfy a vesting condition that was specified at a grant date. So whatever vesting condition that was originally specified on the grant date, we have to consider that condition. And if there is any failure to those vesting conditions other than market condition, then only we can reverse the expense. Otherwise, we have to continue to book the expenditure. And this is the minimum expenditure we have to book. So when we link this paragraph to the para 26 on the modification, for modification, para 26 is relevant, which says that whenever there is a modification which is beneficial to the employee, or you can say option holder, we have to book the additional expense on the date of modification as an incremental fair value. And how this incremental fair value, etc., needs to be calculated, this is given under Appendix B of Ind AS 102. So let us see how they have explained in the Appendix B. So this is the same example like I just discussed. So here we have example of 150 rupees share price and 70 rupees, etc. So now let's directly move to the Appendix B, what it says. So Appendix B says that we have to do the amortization of the original expenditure as a minimum as required under para 27. So let's say original fair value of option was at 20 rupees. So that 20 rupees will keep on amortizing from day 1 to the date of vesting as per the original schedule. That will not change. But for the modification of the exercise price, etc., there is an incremental fair value that we need to calculate. This incremental fair value will be on the date of modification. What is the fair value of the old plan and what is the fair value of the new plan? You can say on the date of modification, what is the fair value before change, after change? That difference we need to account for as a modification expense. And this modification charge we have to amortize from date of modification to the date of vesting. So this is how we need to give the treatment for the modification of ESOP. One amortization will go for the original ESOP expense from the original grant date to the original vesting date. Second amortization will run from the date of modification to the date of vesting for the incremental fair value. So I hope it is clear to everyone. Now there can be one more modification where company is reducing the vesting period. For example, vesting period was 2 years. Now company says accelerated vesting, immediately vested after subject to employee have completed 12 months of service. So in this kind of scenario, since there is no future service, you cannot defer your expense. Whatever unamortized expense was there, we have to immediately book that expense now because it is immediately vested. So I hope it is clear on how we need to deal with this kind of amortization of expense for the modification. Coming to the another important aspect, which is cancellation of ESOP. So let's say company have granted the ESOP, say 1000 ESOP are granted, but now company have cancelled the ESOP, or it may be employee have surrendered the ESOP. Either way it is possible. In both the scenario, accounting treatment is same. Accounting treatment do not differ. Why companies show that employee have surrendered? Because technically, once benefit is granted, company cannot take it back, ideally. So usually for the compliance purpose, it is shown or treated as a employee have surrendered the benefit. But for accounting purpose, this is called as a cancellation of ESOP plan or ESOP benefit, let's say. So for this cancellation of ESOP, usually management or the accounting team feels that since we are cancelling the ESOP, we have to reverse the earlier booked expense. This is the usual expectation, that since we are cancelling, whatever was booked, let us reverse in the P&L. But accounting standard do not work like this. It says that in para 27 again, which says that you have to see the condition which is stated on the grant date. That is the minimum amount you have to book the expense. So there is para 23, 28 and 27, all this combined reading we have to see for the cancellation of plan, which says that all this cancellation of ESOP we need to treat as an acceleration of vesting. We need to consider that all these ESOPs are vested on the date of cancellation itself, and now book all these expense immediately. So whatever was the unexpired time period, which otherwise would have been amortized in the future, that period cost also we have to upfront now only and book the whole cost. This is the cancellation of accounting. Then the question is, now my P&L is booked. So entry is expense account debit to the ESOP reserve. What will happen to this ESOP reserve? Can I reverse this ESOP reserve in the P&L? Or what I will do with this ESOP reserve? So there is para 23 on this, what to do with this ESOP reserve. So para 23 says that once benefit is vested, we cannot reverse this amount in the P&L. Whether employee choose to exercise, not to exercise, they forfeit, they surrender, they lapse, whatever they do, we cannot reverse this amount in the P&L. But it allows the transfer within other equity from one component of equity to another equity. So this ESOP reserve is transferred to general reserve for such cancellation, because now ESOP reserve is not relevant, because whatever ESOP reserve was created, that ESOP reserve is no longer required. So ESOP reserve will debit to the general reserve. So I hope it is clear on the terms of the accounting for the cancellation of plan, as well as you can say forfeiture after the vesting date, because this is also one of the common transaction and one of the, you can say, accounting error also in some of the organizations, where they are not recording the forfeiture or cancellation of the ESOP under para 23. Because in some cases we have observed that they have either reversed that amount in the P&L or they have kept in the ESOP reserve. So that needs to be fairly treated. It cannot reverse in P&L and it cannot remain in the ESOP reserve, because ESOP reserve is no longer required, as though ESOPs are no longer in existence. So these are some of the accounting entries. First, we need to book the P&L charge for the acceleration of vesting, which is P&L account debit to ESOP reserve. Then it may be possible that company is paying some money as a settlement to the employee against this ESOP cancellation. That is very well possible. So for payment of such compensation, let's say my ESOP reserve was 2 lakh rupees and company is paying say 1,50,000. So that 1,50,000 payment will be first settled against the ESOP reserve which is created. So ESOP reserve account debit to bank account, but it may be possible that company may have paid some excess money. So that excess will be debited to P&L account. It has again been observed in some of the transactions that company do not link this cancellation and the compensation. They show it separately. Although it is advised to them, if you show it separately, then it will be double hit to your P&L. Because whatever compensation you are paying them as a salary or bonus, that you are debiting in the P&L. But whatever cancellation cost of ESOP, it is coming in the P&L as part of Ind AS 102. So it is very important for company in the practice to see that appropriate linkage to the cancellation and settlement amount needs to be done. Then if any outstanding balance is there in the ESOP reserve, that needs to be reversed to the general reserve. So I hope it is okay on the cancellation accounting. Now moving on to the group share-based payment arrangement. So what is group share-based transactions? Let us say there is a holding company A Limited, which is a listed company or unlisted company as the case may be. So they have prepared the ESOP scheme under company A, and company A is giving their shares as a benefit to their own employees, to the employees of B, C, etc., which is the subsidiary companies. So this is called as a group share-based payment transaction. This is well covered in the Ind AS 102 as well as in the guidance note accounting of share-based payment 2020 version. So what standard says, whenever we have this kind of group transaction where one company is settling the transaction of other group company, etc., we have to apply this para 43 ABCD of Ind AS 102. Now let us see how these paragraphs are structured and they deal with the ESOP accounting. So para 43B is very well relevant. It says that entity which is receiving the goods, so it is talking from the perspective of entity where service is rendered. For example, subsidiary limited, in our example B Limited, where employee is rendering the services. So it says that entity where service is rendered, they shall measure the goods or services received as an equity settled transaction when awards granted are its own equity instrument. So question is, in this scenario where employees are getting the shares of A Limited, so whether they are getting shares of B Limited, so this condition is not satisfied. So in 43B, the first condition is not satisfied, but there is or. So basically there are two conditions. After these two, if one condition is satisfied, then this subsidiary company has to book the transaction as an equity settled transaction. So first condition is not satisfied, which says that awards granted are its own equity instrument, which is not the case. Second is entity has no obligation to settle the share-based payment transaction. So here, who is settling this transaction of equity settle? This shares will be issued by the A Limited holding company. So the B Limited do not have any obligation to settle the transaction. So this condition is satisfied. First condition was not satisfied. Since any of the two, one condition is satisfied, we have to book this transaction as an equity settled transaction for the purpose of subsidiary company. In all other circumstances, the entity have to record as a cash settled transaction, because the classification of cash settled versus equity settled is very important. That we have seen. If it is equity settled, it is grant date measurement. If it is cash settled, it is every reporting date we have to keep on recalculating fair value. So this classification is very important. Now moving to para 43C. 43C is from the perspective of entity settling the transaction, which means A Limited in our example. So it says that entity settling a transaction when another entity in the group receive the services. So another entity is B, they are receiving the services. So till here it is okay. So this A Limited has to recognize the transaction as an equity settled transaction only if. So here we have only one condition. It is settled in entity's own equity instrument. So question is whether this A Limited is giving their own shares. Answer is yes, they are giving A Limited shares. So A Limited is having the obligation, they have to record it as an equity settled transaction. Otherwise, it will be booked as a cash settled transaction. So in this example, both A and B will book the transaction as an equity settled transaction. I hope it is clear till now. Now I have given one grid for various different transactions. So first one is we just discussed. Let me explain the rationale for some of these again. So let's say the first transaction, award is given by parent A Limited, and what they are giving shares of parent only. So I am giving my own shares, A is giving A shares, and in all these transactions, service is given in the subsidiary B Limited. So for the parent consolidation, the outflow is equity. So they will book as an equity settled transaction. Parent standalone will also book as an equity settled transaction because of the 43C, they are giving own shares. Subsidiary will book as an equity settled because they do not have any obligation. So second condition is satisfied. Now let us evaluate the second transaction. So award is given by the parent company. What they are giving? Cash based on the parent's share. So let us evaluate from the parent side. Parent is giving what? So 43C says if the settler is giving their own shares, then only equity settle, otherwise cash settle. So now parent is giving cash. So parent will book as a cash settled transaction. From the consolidation perspective, as a group, what is going out? Cash is going out. So it will be booked as a cash settled transaction. When we come to the subsidiary books, in case of subsidiary books, who is having the obligation? Parent is having the obligation. So in that scenario, the subsidiary will book the transaction as an equity settle. I hope it is clear. It may be possible the similar transaction where benefit is given as a dependent cash based on the parent's share price, like this transaction. But now commitment is given by the subsidiary themselves. कि subsidiary ने बोला कि हमारे एम्प्लॉयज को हम पैसा देंगे, पैसे का वैल्यू डिसाइड होगा पेरेंट के शेयर प्राइस पे. This kind of transaction can also very well be there. So in this kind of transaction, since subsidiary is giving the cash, now we have to see 43B from both angles. Two conditions. First condition was they are giving their own shares. No, they are not giving their own shares. So condition 1 failed. Second condition, subsidiary do not have any obligation. So this condition also fails because subsidiary is giving the obligation. They have the obligation to pay the cash. So in this transaction of subsidiary, they will book as a cash settled transaction. And as a group, cash is going out, so they will book the cash settled transaction as a group level. When it comes to the parent standalone transaction, parent is not paying anything because only their share price is linked to the transaction, but they are not giving anything, they are not receiving anything. So parent standalone, there is no treatment of this ESOP. So I hope it is clear. Like this, there can be various permutation combinations which can be created. This is the accounting entries for the group share-based payment transactions, where it says that as per 43B, for the entity which is the subsidiary company, we have to book the expense. And since it is an equity settled transaction, let's say, the ESOP reserve will be created by the holding company. So the subsidiary company will record the transaction as a capital contribution from the parent company that will be shown as a other equity. It also may be possible that employee keep on transferring from group A to company B to company C and D, etc. also. In that case, respective company will book this expense of expense account debit to capital contribution equity. And holding company will do the accounting of investment in subsidiary account debit to equity. There is para 43D also. As I told, there are four paragraph 43 ABCD. 43D is also very important, which says that it may be possible that these group companies have a system of intercharge for the reimbursement of this expense. So irrespective, they have a system of reimbursement. We have to follow the accounting treatment as per 43B and C. So if it is possible that both this subsidiary holding, they are doing the intercompany settlement as a reimbursement, debit, credit, etc., then this capital contribution and cost of investment, this line will replace by the intercompany account. For example, expense account debit to payable account, because they are paying some money to this group company. Similarly, the holding company will book the transaction as a receivable account debit to equity account. So I hope it is clear. And if these ESOPs are unvested cancelled, then this expense is also reversed as per Ind AS 102 requirement. So for forfeiture of ESOP which is unvested, like employee left the company without completing the service, so that time we need to reverse the expense whatever was booked. It may be possible that there are some other employees in the company, so overall we can have a net debit. But it may also be possible that some material transaction person have left the company, so it can come into net reversal in the P&L also. That is also very well possible. So the same treatment will follow here for forfeiture of ESOP on unvested ESOP. For vested ESOP, we cannot reverse in the P&L because para 23 is very clear. In para 23, it says that for vested ESOP, it cannot go back to P&L account. So I hope this transaction is also clear. Now let's see some of the key differences in the Ind AS 102 to the ICAI Guidance Note 2020. Plus, we also need to see Guidance Note 2005 because there was one old Guidance Note 2005 which was replaced from Guidance Note 20 from effective grant date after 1 April 21. It may be possible that certain grants from the old period are still standing in the books. So this is relevant to understand the difference from both the guidance note and as part of the practical exposure which we have gained from our experience. That also I will try to explain here. So let's say if we talk about the current version of Ind AS 102 versus Guidance Note 2020, one important difference, as I highlighted earlier, is that Ind AS 102 requires fair value to be booked in the P&L, whereas Guidance Note says we prefer that you book as per fair value method, but it is allowed for the company to follow either intrinsic value or the fair value method, but disclosure has to be done as per the fair value accounting. So this is the key difference in the Ind AS versus the current version of Guidance Note. You can say this is the only one difference, because earlier there were a lot of differences. They were now removed in the current version of Guidance Note 2020. So we need to see some of these differences of 2005 Guidance Note versus 2020. Like non-employee share-based payment transactions, they were not covered in the earlier Guidance Note, but they are covered in the new Guidance Note. Like if we are settling the share-based payment with the non-employees, then they also have to be booked as per Guidance Note accounting, which requires the direct measurement on the date of transaction. Similarly, this group share-based payment transaction, A Limited, B Limited, as per the old Guidance Note, there was no requirement to book such expense in the B Limited, which is the subsidiary. So we have certain examples or cases in our practical life where holding company have granted the ESOP to the subsidiary company, and subsidiary were not booking the expenditure under the existing Guidance Note, but in the new Guidance Note era of 2020, effective post April 21, they have to book the expenditure in the subsidiary. Another important difference is recognition of graded vesting. In case of Guidance Note 2020 and the Ind AS 102, it requires the separate grant approach. For example, if you have graded vesting of 30, 30, 40, 3 tranches, we have to book the expense for 3 different parts separately. For example, first part will be amortized over 1 year, second part will be amortized over 2 years, and third will be amortized over 3 years. But in case of Guidance Note earlier version, the standard have given 2 choice. Either you follow separate grant approach like this, or you follow single grant approach. What is single grant approach? Total 100 shares given, so you directly take 1/3. You consider all pool as a 1, and single 1 divided by 3 you can book as a expenditure, subject to minimum expense of that particular first year's vesting. This kind of option is there in US GAAP also. So earlier Guidance Note was, you can say, on the lines of US GAAP, but the new Guidance Note is more on the verge of the IFRS, and because our Ind AS is on the IFRS. So I hope you can see why this transition is there in terms of the Guidance Note 2005 to 2020. So this is the important one. Now we have 2 more poll questions on the screen. So I will request our IT team to launch the poll as well. So the question 3, it asks that which accounting entry is required when options are granted to employees, whether we debit to retained earnings, we credit to the salary, we debit to employee benefit expense, or we credit to share capital. So which is the correct answer in your view? This is one case we already discussed, but we just want to understand how much focus and practical experience you have on this. Question 4 is, first let us wait for the members to get this answer on the question 3. Meanwhile, let me explain question 4 as well. What is recognized for cash settled share-based payment at the each period end? So this is the example for cash settled transaction. A expense based on the grant date fair value, liability at fair value, equity at fair value, or deferred income. Now we can launch the fourth question in the poll and request members to answer this. Well, let us move further. Okay, let us discuss the correct answer also. So for the first one, the accounting entry when options are granted, so it will be debit to the employee benefit expense. This is the right answer because it is not credit to salary, it is expense. It is not debit to retained earnings, it is credit to ESOP reserve. It is not credit to share capital, it is credit to the ESOP reserve. So this is the right answer, debit to employee benefit expense. In this fourth one, it is a cash settled transaction. So first option is expense based on grant date fair value. Second is liability at fair value. So it will this is more appropriate, liability at fair value, because it is cash settled transaction. So liability at fair value is more appropriate because expense based on grant date fair value may be more appropriate for the equity settled transaction and not for the cash settled transaction. Since it is cash settled, equity at par will also not be relevant and it is not income, so D is also out of the box. So C and D's are out and A is also out because grant date fair value is not used. So it is very important. Sometimes we have to see the elimination approach while selecting the appropriate answer. Now let us see the taxation and the disclosure requirement. So coming to the taxation for the employees. So for employees, the taxation will be there at the time of exercise of ESOP. Whenever employees exercise the ESOP, that time they have to pay the taxes. On grant date, there is no tax. On vesting date, there is no tax. But on exercise date, they have to pay the tax as a perquisite income. And this will be taxed as per the slabs. Now, since we have taxed the employee on exercise date, this share price on the date of exercise will become my cost of acquisition for the purpose of capital gain at the time of transfer of shares. So I hope it is clear. Further, some relaxation is given for this exercise tax for the startup companies. If company is an eligible startup under the DPIT, then the income tax have given the relaxation. It says that this tax of the perquisite tax, it can be deferred up to earlier of 3 dates. One, employees sell the shares because now we have realized the money, so pay the tax of perquisite tax as well. Second is employee is leaving the company. Now you pay the tax because ESOP was given with the objective for employee to stay with the company and long-term objective. Third one is 5 years from the end of that period. So 5 years is enough long-term period for the employee to pay the tax. So these are the 3 different dates which is given for payment of the deferment of taxation, you can say. Coming to the taxation for the company. For company, there is no clear-cut answer given in the Income Tax Act that whether it can be allowed expenditure, it is not allowable expenditure. But there are various case laws on the ESOP expenditure, which says that one of the important case laws is the Biocon Limited case law, where it is argued and allowed the ESOP expense in the favor of assessee, that ESOP expenditure can be allowed as expenditure while computing the company's taxable income. But that case law is from the time period of non-Ind AS where intrinsic value was more prevalent. So some companies on safer side, they take the expense allowance on the intrinsic value, while practice exists where some companies allow the expenditure with the same logics on the fair value as well. While in some cases, AO still wants to argue and say that not to allow the expenditure. So all these varied practice exist in case of ESOP for company taxation. So maybe if more clarity comes from the Income Tax Act in the future as some amendment, that will be helpful for the companies, because in the new Income Tax Act also 2025, there is no much clarity and this ambiguity still remains. Coming to the some sample disclosure by the listed companies on the Ind AS 102. So for listed companies, one disclosure they need to give in the director's report as required under the SEBI regulation for the gist of the ESOP scheme. What are the key characteristics when it was approved? What is the ESOP pool, etc. Then the movement of ESOP. Any senior management employees have been granted the ESOP, etc. So let me show you one Excel file for the sample disclosure for the listed companies. So this is one file which is downloaded from the WIRC portal where they had given the disclosure of various Ind AS for the various listed companies. So we can pick any of the company and see the disclosure given. So disclosure mainly, so this is from the notes to account, not the director's report. So director report also have some of these disclosure which is common as per Ind AS 102. Usually the director's report disclosure company put on their website also as a separate download link button as well. This is the extract from the Ind AS disclosures. So they have to disclose for different ESOP grants, what is the exercise price, number of ESOPs which are outstanding, etc. for different dates. Then the movement of ESOP for what is granted outstanding at the start, how many granted. Then what is the lapsation of ESOP, if any forfeiture is there, if any exercise of ESOP is there, what is the closing balance, etc. So these disclosures are given for the option movement. Then for the same option movement, we need to disclose exercise price of the option. Then we need to disclose the parameters, or you can say assumptions of the ESOP valuation. Like we discussed the 6 parameters of the ESOP valuations: the dividend yield, expected term of the option, risk-free interest rate, volatility, etc. Then we need to disclose all the relevant other items, if any modification is there, method of valuation, etc. So that's how this is relevant. This particular Excel file is more relevant because it gives various listed company disclosures at one place. Now let's come to the next part. Some of the practical points or issues in the ESOP accounting and ESOP valuations, or you can say ESOP audit, because we face all these concerns, let's say. So one is how to determine the attrition rate, lapse rate, forfeiture rate, whatever term we can give it, for the purpose of ESOP expense accounting, because ESOP expense is calculated for options expected to vest. So ideally, such attrition rate needs to be calculated based on the past experience of the number of ESOPs which are forfeited unvested, divided by total ESOPs granted for each category, and during what period that ESOP was existing. So based on that, we can determine the annualized attrition rate. One more question comes from the auditor or the management sometime, whether we use the attrition rate as a per annum rate or we use lump sum rate, for example, 20% for the lifetime. So our belief is it should be per annum annualized rate. The reason is in the practical life, we will have the ESOP with a graded vesting. Some ESOP is having a vesting of 1 year, 2 year, 3 year, 4 year, and life will not be easy where all the ESOP are granted on 1st April. Because ESOP will be granted on some odd dates like 10th July, 15th October, 10th November, etc. So on the balance sheet date, we will have different options outstanding with a different future unexpired period. So ideally, such attrition rate should be used for the future unexpired period of the relevant vesting, since calculation requires use of expected to vest. So my attrition rate should go only till the vesting date, not till the exercise date, because vesting date is here, but exercise date can be there. So that's why we have to consider options expected to vest and not expected to exercise. This is very important. Then some important consideration we need to give for the employees who actually left the company. Because for employees who left, it can be possible some unvested ESOP gone or some vested ESOP is forfeited. So we need to have a suitable allowance for the same, because vested ESOP forfeiture, they will route through reserves and not the P&L. Similarly, when we calculate this expected term of option, we need to give a suitable allowance to the past experience and the management expectation that when ESOP will be exercised from the grant date. When we talk about the amortization of expense, maybe for monthly, quarterly, or annual reporting, we need to carefully see that we have to give allowance to the options expected to vest, because many times it has been observed that company consider options active as on reporting date and do not consider options expected to vest. So that will lead to additional expense in the current period and lower expense in the future. So that will not reflect the true and fair view and not reflect the requirement of Ind AS 102. So we have to consider suitable forfeiture rate. Then ESOP fair value, where benefit payout is guaranteed or some performance link of share price or some performance of individual employees, etc. So if it is a market-based condition, if you remember, the regular Black-Scholes model will not work. We have to move to Monte Carlo simulation. And if it is employee performance or company performance other than market, then they do not factor in the fair value. They factor in the number of options expected to vest. Volatility assumption sometimes becomes more tricky for newly listed companies or unlisted companies, because then we have to see the volatility of the peer companies. It may be possible that some peer listed companies also not available. Then in that scenario, we may have to consider the index volatility as well. Then next is whether ESOP valuation is to be done by whom. It has to be done by registered valuer or actuary or merchant banker. This kind of question also comes sometime. So under Ind AS 102 or the Companies Act, there is no specific requirement that who can do, who cannot do the ESOP valuation. So in the industry, as per the practice, it is usually done by the actuaries, because this ESOP valuation, it requires a lot of statistics, mathematics, and the calculation of ESOP expenditure requires a lot of use of attrition rate, probabilities, and projections. So due to these reasons, it is usually done by the actuaries in practice. Further, Institute of Actuaries of India have also come up with the guidance note on the share-based payment for the actuaries while they do the calculation for the actuaries. So one is the guidance note issued by the ICAI for overall accounting purpose. Based on that only, how actuaries need to abide themselves for calculation of such ESOP expenses of fair value, etc. There is a separate guidance note issued by the Actuaries Institute as well to ensure that actuaries follow that professional path for the appropriate calculation aligned with the ICAI guidance note and the Ind AS 102 obviously. So this is all from my side. Now we can have the questions from our participants.
Thank you. Thank you so much, sir, for your insightful contributions and for covering the topic with such in-depth and clarity. Now
Thank you.
we have certain questions from our participants. The first question goes like, if employees do not meet the vesting conditions, how should companies account for the reversal of previously recognized share-based payment expense?
Perfect. So let us, so this is already covered, but for the better clarity, let us take one example. Say we have granted 100 ESOPs to the one employee with a 4-year graded vesting of 25 each year. And employee have completed 2.5 years of service. So first two part, which is 50%, is already vested. But in the P&L, full expenditure has gone for first two parts. For third and fourth part, some expenditure has gone on an amortization basis. Now for the first two parts, which is fully vested, we cannot reverse it in the P&L. We have to transfer this to the general reserve if employee choose not to exercise. It may be possible that employee have exercised the first two part of 50 options because benefit is already vested. In case employee have already exercised the ESOP, there is no question of reversal for the first two parts. For the next two parts, they cannot be exercised because service is not completed. So they will reverse in the P&L only. So what will happen? This calculation will be done by individual employee, and then at a total level, we have the accounting entry for the company. So net basis, it may be possible that we have a overall expenditure in the P&L with a net reversal coming out of that employee. So this is how the overall accounting will go. And one more important thing is, since there are group of employees, company have already factored in the attrition rate assumption. So let's say company have already expected, say 10% employees to leave. So if that actual forfeiture is within that range, so then there will be no unusual reversal because this was already factored in that some employee will leave. It may be possible that actual left is lower or more than that assumption, so that true up and true down will come in the P&L.
Oh, thank you, sir.
Yeah.
Next question. For unlisted companies, how should fair value of options be reliably determined in absence of market data? Are level 3 fair value inputs sufficient disclosure?
Yeah, ideally the level 3 inputs will be the only possible way because the level 1 and 2 inputs will be very difficult for unlisted companies. So mainly we have to rely on the, you can say, the independent valuation report, or you can say the nearest to the ESOP grant. If there is a issue of the shares of a good sizable quantity, we can consider that also as a fair value of the share. We have to apply a suitable professional judgment while considering this market value.
Thank you, sir.
Yes.
In cases of graded vesting, why is it necessary to treat each vesting tranche as a separate grant?
Yeah, this is very important question. So in case of graded vesting, the standard requires that it has to be considered as a separate grant approach, while the US GAAP gives an option, single grant versus separate grant approach. Like if we remember our this discussion from this slide, where we talk about the single grant approach versus the separate grant approach. So the old guidance note of 2005 was on the lines of the US GAAP, which gives an option to the entity single grant versus separate grant. But in case of IFRS and the Ind AS 2, it requires them as a separate grant approach because it shows that the employee have to complete the service, and the fourth year benefit is not just for the fourth year. Employee have to serve full 4 years to get the fourth year benefit. So that's why we need to consider it as a separate grant. And in this model, maximum expenditure will come in the year 1. If company would have not done the enough analysis of the accounting expenditure, they would have thought that 25 will hit in the P&L every year. But that's not the case. 52 rupees will come in the first year, then 33 will come in the second year, then further low and low in the last year. So last year expense will be only 8 rupees. So the early shifting of expenditure is therefore graded vesting. So I hope it will answer the question.
Okay, thank you, sir. When an ESOP scheme is modified to reduce the exercise price, and what incremental expense needs to be recognized?
Okay, just let me see. When an employee scheme is modified to reduce the exercise price, okay. So firstly, let us say in our example, the share price on the grant date, original grant date was, let's say, 100 rupees, then share price reduced to 70 rupees. Now, since the share price is also coming down, so company feels that exercise price of 70 is not relevant, so they reduce the exercise price. Why this reduction is required? To keep the ESOP attractive and meaningful to the employee. So what we need to do, the original fair value of option that will keep on amortizing for the original vesting period. On the date of plan amendment, let's say date of plan amendment is 1st January 25, let's say. So on this date, we have to calculate all the parameters. Share price on this date, exercise price will be old and new. As per old plan, exercise price 70 rupees. As per new price, exercise price, let's say 20 rupees. Then discount rate on this date, volatility on this date, expected term on this date. So all the 6 parameters has to be calculated on the date of plan amendment for the new scheme and the old scheme. Then the difference of that fair value will be called as an incremental fair value. And this incremental fair value we will amortize over the remaining vesting period from the date of plan amendment to the date of vesting. It may be possible that certain options already vested, because let's say our graded vesting having 3 years. So first year options already vested. So for the benefit which is already vested, there is no future amortization period. So in that case, we have to immediately book the full expenditure. So this is how we need to book the expense for the modification.
Okay,
So
sir.
I hope this is clear.
Next one. What is the accounting treatment for a modification of a share-based payment transaction that changes its classification from cash settled to equity settled?
Yes, that is also very well possible that company do the changes from cash settle to equity settle, or vice versa, equity settle to cash settle. So in that scenario, we need to, on this date of changes from cash settle to equity settle, we need to calculate this fair value of option. We have to lock this price. Now on this date, the liability will move to the ESOP reserve as required, because now it is no longer a provision. It will move as a ESOP reserve. So that's the key classification change for this kind of modification. And in future, the treatment will be as per the equity settle, because equity settle requires the transaction where fair value will not change in the future. So now that price will be locked and the future changes in the share price will not be taken care.
Sure, sir. Thank you.
Yeah, and anyway, this is a kind of a complex transaction, not usual transaction. So one need to carefully see the accounting standard paragraphs and also the basis for conclusion, because for the complex transaction like this, it may be possible that it is better to refer to the standard and basis for conclusion whenever this kind of transaction occurs. Yeah.
Thank you. Next one. The company had granted ESOPs in earlier years, which have already been exercised by employees.
Correct.
However, deferred tax was not recognized at the time of grant. Company now intends to create deferred tax relating to these ESOPs. How should deferred tax be recognized in such cases? Further, since the company's share price is highly volatile, the deferred tax impact fluctuates significantly across quarters, resulting in alternating recognition of deferred tax assets and liabilities. This, in turn, leads to wide variations in reported PAT, making it challenging to explain these movements to investors. How can such volatility in deferred tax and PAT be appropriately managed or presented?
Yeah, so this is again one of the complex question. So ideally, in this kind of transactions, wherever ideally the deferred tax should be considered on the grant date fair value and not as per the value which is as per the current share price. Because since the question refers to ESOP, I assume it is a equity settled transaction. So in case of equity settled transaction, the fair value of expense is recognized on the grant date fair value and not based on the future changes in the share price. So question of this kind of volatility will not come, because company will not be allowed to claim the expenditure as per the future changes in the share price. So ideally, if any deferred tax is created, then it should be created as per the original fair value. Second is, it may be also possible that company is allowing this expenditure in the year of P&L debit only, rather than exercise period. So in that scenario, there is no question of deferred tax because there is no timing difference. So as I explained earlier, for the company taxation, there is no fixed one single account with this taxation practice. Some companies follow the allowing the expense on an immediate P&L basis, where some companies do it as a deferred tax and then allow whenever they exercise the ESOP. So, but if they are creating deferred tax, then also it should be on the grant date values and not having any fluctuating impact. So I hope this will address the question. So thank you very much. I think there are no further questions. Thank you to the team for this opportunity. Handing over to you, Neha.
Thank you so much, sir, for this insightful session. My sincere gratitude also goes to the chairman and vice chairman of ASB for their thoughtful leadership in bringing this Brain Gain Expertise series to life, ensuring that our members and stakeholders benefit from such valuable, knowledgeable, and knowledge sharing. Last but certainly not the least, I deeply appreciate all our viewers for their active participation in this webinar. Your engagement is what makes these initiatives truly meaningful. Thank you so much, everyone.
Thank you. Namaste.
Yes, Sanket, you may end. Thank you, ma'am.
Thank you, sir. Thank you so much.
Okay.
Recording stopped.